Hello everyone. Today, actually, I'm gonna talk about is your Social Security benefit taxable. So, why you need to know is your Social Security benefit taxable, or you how much is taxable? Let's say if you are retiree, you currently retired, you're taking Social Security benefit. You have to understand that your Social Security benefit may be taxed based on another additional income you received, how much income you received. So your Social Security benefit can be taxed up to 85% of your Social Security benefit. So also, if you want to avoid your Social Security benefit to be taxed, then you should do some understand how much it may be taxed, then do some tax planning. Say if you currently receive $30,000 per year Social Security benefit, then you need additional $50,000 to live on for this year. So you know how this, if you withdraw the $50,000 all from your retirement account 401k, they are considered your taxable income. That definitely trigger your Social Security benefit to be taxed. So but however, if you withdraw $50,000, it's let's just say you only withdraw $20,000 from 401k, then maybe do $20,000 from your Roth IRA. This is not taxed, so won't increase your taxable income. Then $10,000 from your bank account. In this way, you'll save tremendous tax on your Social Security benefit. So you may not need to file tax at all in some situation. So that's just intelligent way to manage your retirement income. How you withdraw your money. Also, another thing is if you have a brokerage account, you have an investment invested. Also, how you you want to withdraw some money from there to living on. So which assets to sell? Let's say you want to sell some, if you currently have a very little low income, so then you can sell some with larger capital gain. So if on the other hand, if you currently have lots of income, so you should sell some assets that have, even have a capital loss. That will, how you do it is really help you to reduce the amount of tax, also avoid Social Security benefit tax. If you I listed here also, if you participate in the investment, have brokerage account, you invest some money in your brokerage account. If you don't want to receive lots of income in that account, you should avoid the dividend stocks or mutual funds or those investment. Maybe you should invest in the growth growth stock, or they don't pay dividend, won't trigger you or Social Security benefit tax. So that is all together. So how to manage your retirement income, avoid tax. So let's do here. Okay, before we get into that, I just want to say, okay, majority of the information here, I'm taking the information from the IRS website, especially the IRS publication 915. I will list the link below of the video. So that way you can have the reference, everything. So Yeah, okay. Let's see how your Social Security benefit taxed and how much. And so before we dive into that, I use the term is from anyway this term called provisional income, which is it's easier for I to explain here. So just call PI. Usually, IS will tell you that okay, let's give you a quick test. Let's say all your other income together at 50% of your Social Security benefit. Then compare this to a base. So I will talk about the base later. But that just a very quick way to do that. You can consider, but this one is more detail. We call PI, provisional income. So you basically later you compare the PI to the base. So anyway, so this is a PI. Your adjustable gross income AGI plus 50% of Social Security. The reason you have to understand any thing is not included in your AGI, like a tax exempt interest, foreign incomes. Then also you another thing you understand, if you make any contribution to your traditional II, actually that one reduce your PI is your benefit. So I have an example for this later. So basically, the PI you compare to the base. If this is greater than the base, then your Social Security is being taxed. So let's do the base. This is the base. The base amount is different based on your filing status. If you are married, filing joint, the base is $32,000. If you are single, head of household, qualified widower, the base is $25,000. This is married filed separately. It's very interesting. So if you are married and filed separately, and if you and your spouse not living together, let's say because the job situation, you both whatever, living one in New York, one in LA, so then you filing separately, you are not living together whatsoever. So then in this situation, so then your base is $25,000. But however, if you filing separately, you're married filing separately, and then you are living together, or even just living a little bit together, so then your base is $0. This is very bad. So I will show example later that why is so bad. So okay, this is the base. You have to like before, you compare this PI amount with the base. If your PI is, let's say you're married filing jointly, if your PI is less than $32,000, then your Social Security benefit is not taxed. So if you are single, head of a household, qualified widower, if your PI is less than $25,000, your Social Security benefit is not taxed. So this is so simple. Compare PI to your base amount. Okay. So there's another adjust the base amount. Why they have this? Maybe I should show you. Okay, so let's learn a little bit about adjust the base amount. So basically, if you are married, filing jointly, there's an additional $12,000 to add to your base. The reason they is to decide if your Social Security benefit is taxed at your 50% social security tax or your 85% social security benefit tax. So maybe this might help. So basically, let's say you learned about PI and you learned about the base, adjust the base. So if your PI is less than the base, so zero, your social security benefit is zero taxed. If your PI is greater than the base, then the smaller than the adjusted base, then your social security benefit is 50% of them are taxed. 50% of your social security benefit is added to your adjusted gross income to be taxed. Okay, so it's usually taxed at your marginal tax rate. Then if your PI is greater than adjusted base amount, then this situation, your 85% social security benefit is taxed. So now you learned, why you use PI base amount, adjust the base amount. So this is just the thing. If you are married jointly, so this is the base amount, adjust the base amount. Then if you're single, head of household, qualified widower, so this is your base at the adjusted base. So anyway, so you need to pay attention to this. If you are married, filing separately, and you guys living together, so then your base adjusted base or zero, which means even you have a $1 social security benefit, those $1 you have to pay 85 cents to the your 85 cents of this $1 is gonna be taxed. Okay, gonna be taxable. So this is very disadvantage for you to have this filing status. Anyway, so let's go through some examples. Okay, so basically that's this is the detail I tell you, why the base. So just as I told you, the let's say if you are married filing jointly, so if your PI is less than $35,000, zero social security benefit is taxed. So if your PI is between $32,000 and $44,000, so your 50% social security benefit is taxable. Your PI greater than $40,000, your 85% of your social security benefit is taxable. However, it's not just the 85% taxable. However, I don't know why IRS do this. They just try to make things complicated. Usually just simply 85% social security benefit is taxable, but they make a little thing. Well, it's like okay, maybe my PI just a little bit higher than the $44,000. May that is make my 85% social security benefit taxable. They kind of help you a little bit. If you just a little bit higher, maybe they're gonna tax on less. So this is the situation. When your PI is greater than $44,000, the taxable amount is lesser. Let's say the amount of 85% of your social security benefit. The other one is if let's say this is PI amount excess 44,000 85% of this, then plus lesser of your 50% of social security benefit, or 50% of, if you see this 12K is the adjustable amount, the 12K is added to your base amount to get in 44K, so that's why it's 12K here. So basically, yes, is your if your social security benefit is less then 12K, you are beneficial to you because you're gonna use less amount. So anyway, so they added maximum. They added like $6,000 here. So basically, if you are your PI just a little bit higher than the 44K, is beneficial. Your Social Security benefit maybe is a little bit less than 85%. So that's just a little thing there. It just make everything complicated. So let's go through some examples. Okay, first example. So it's married filed jointly, right? Married filed jointly. Let's just see. This situation is 85% of your Social Security benefit is taxable. Let's just see the situation. Okay, Mr. and Mrs. Smith, they both over 65 years old and filing jointly receive $20,000 in the Social Security benefit. Additionally, they report $30,000 taxable interest, $15,000 tax exempt interest, $80,000 dividend, and taxable pension of $16,000. Okay, giving all those are all their incomes. Okay, let's say if they do AGI, what's their AGI? AGI is their taxable, this is a taxable income. $30,000 interest, obviously, $30,000 interest. Then $15,000 tax exempt interest, so which means you don't need to pay tax on it. So now include in your adjustable gross income. So then your $18,000 dividend need to be taxed. It's ordinary income. Then your taxable pension. You have to understand the taxable pension, 401k, traditional IRA. So they are the same thing. So they are added to your taxable income. So here is your AGI, $64,000. Here we say excluded the Social Security benefit because we don't know how much your Social Security benefit to be taxed yet. So that's why we try to figure it out here. So this is AGI, right? AGI. Then now we have to figure out your PI because we're gonna compare the PI to the basis, then to figure out how much your Social Security to be taxed. Let's say your AGI. You have to remember that all the tax exempt income, they will be added back to increase your PI. So your AGI plus $15,000 tax exempt interest, then add the 50% of your Social Security benefit. So we get $89,000. Then you compare this $89,000 to the base. If you remember the base is PI greater than $44,000, then up to $85,000 your Social Security benefit is taxable. So basically based on this one, that immediately we know 85% of your Social Security benefit is taxable. But we have to, to find out if your 85% Social Security benefit is bigger or smaller than the 85%, the other scenario. Then in this scenario, is 85% of your excess amount, then plus on the lesser of your 50% Social Security or 50% of the adjustment, $12,000. So get the amount is $44,250. So compare this amount to your $17,000, 85% of your Social Security amount. So it's smaller. This one is lesser. You're lucky, so they only gonna tax you on the 85% of your Social Security benefit. So your $17,000 Social Security benefit will add to your AGI, your taxable income, to be taxed. So I calculated your taxable amount on the Social Security because they're gonna be taxed at your marginal tax rate. So your marginal tax rate is 22%. So this is $3,740. So basically, in this situation, you're gonna pay additional $3,740 on tax on your Social Security benefit. If you look at all the income here, you received $20,000, let's just say $30,000 taxable interest, $15,000 tax exempt interest, $18,000 dividend, pensions. So besides the pension usually, they give you monthly, so a lot of times you have no flexibility. But for other things, say, can you manage your dividend in a different way? Maybe invest in the growth investment rather than pay you dividend. So that way you can withdraw money more flexible, because the dividend is less flexible. Once they earn dividend, no matter if you are reinvested or not, you're gonna be taxed on those dividends. So if you don't need the money whatever, so if you always reinvest your dividend, maybe you would consider to choose the investment on the growth rather than pay you dividend. So that's something you can do there to try to reduce your taxable income to avoid this Social Security benefit tax. The same thing is report on $30,000 taxable interest. So basically, they may reinvest in the corporate bonds or government bonds. So those things, so large amount receive the interest. Maybe you can invest in those things in different investment. So give you better return than avoid all those interest income. So anyway, so that's just something you need to consider, how to avoid this $3,000, almost $4,000 tax, unnecessary tax, right? You can totally avoid them. Okay, this is the first example. There's another example. The reason I want to go through this example because you have to understand, if you make a contribution, this is a purely example from the IRS, website. So the reason I want to show this because it's very interesting things. If you make a contribution to your traditional IRA, so this can reduce your PI. In this example, you will find out this couple, they if they didn't make a contribution to their traditional IRA, 50% of their Social Security benefit will be taxed. But just because they made a $1,000 contribution to their traditional IRA, they avoid the Social Security benefit. So this is just it's a great information you should know. Let's just say, especially when you retire, you receive Social Security benefit. You have to know current is 2020. There's a called Secure Act in 2017 and 2019. They just passed. That's a great thing. They Usually, if you are over 70 and a half years old, you are not eligible to make a contribution to a traditional IRA. Actually, they removed the age cap right now. So basically, no matter what age you are, as long as you have like earned income, you can make a contribution to a traditional IRA. I mean, you put money in the bank account or put money in the traditional IRA. Doesn't matter if you are over 59 and a half years old. You are eligible to withdraw them anytime. So why don't you just put money in the traditional IRA, so that way you will reduce your taxable income, reduce your taxable income, to reduce your PI to avoid the Social Security benefit tax. That's just a great thing. Okay, let's go over this example. So basically, Ray and Alice, they married filing jointly. So Ray is retired, receive fully taxable pension. Ray's pension is this much. Also receive Social Security benefit. The benefit amount is $5,600. Then Alice is working. So because she is working, she has an earned income, so she is eligible to make a contribution to the traditional IRA. So you have to understand this traditional IRA have to be deductible. If your income more than certain amount, your contribution to the traditional IRA is not deductible. In that case, you probably, if you make that much money, your Social Security benefit definitely to be taxed 85%. Okay, so you don't need to worry about over there. So anyway, so if you make a little money, then you make a contribution. So then definitely is before tax, then is tax deductible. In this situation, let's see AGI. Basically, their marriage joint AGI is $15,500 from the pension, $14,000 from the wage, then the 250. Sorry, this is not K. Just 250. $250. So that way, so total is $29,750. So this is their AGI. Let's without. So if they let's figure out their PI. So this is without IRA contribution. Their PI. So their PI is 32. So basically, add the 50% of the Social Security benefit is 32,550. You compare this to the base. The base is $32,000. So it's greater than the base. If you remember that this is greater than the base, but it's smaller than the adjusted base of $44,000. So that way, so this tell you 50% of Social Security benefit is taxed. So if Alice didn't make the $1,000 contribution, so they are 50% of the Social Security benefit gonna be taxed. So because they made a contribution, so PI reduced by $1,000 the contribution. So now it's 31,550 is less than the $32,000. So it's no Social Security benefit is taxed. So you can simply see, they just maybe saved like a few $100 tax just by simply put money in the traditional retirement account. That's just not different from put it in your bank account, because If you're 59.5 years old, so then that's just you can withdraw anytime you want to. Anyway, so that's just a great thing, a piece of information you should know. So okay, so here is for single. If you are single, head of household, qualified widower, only different because the base reduced. So your PI, if you your PI is less than $25,000, your Social Security benefit is not taxed. But your PI is greater than $25,000, less than $34,000, your 50% of your Social Security benefit is taxed. And your PI greater than $34,000, up to $85,000. 85% of your Social Security benefit is taxed. Excuse me. So this is the same thing with the marriage joint. So they give you just a little bit over the $34,000. So maybe the taxable amount is less than 85% of your Social Security benefit. So that's just the same thing you need to know. So let's go over an example. This is show you 50% of a single person Social Security benefit is taxed. This is called George White. He is a single, filing single, obviously. In addition to receive Social Security payment, he received fully taxable pension. So this is taxable 18,600, which from the part-time job. So he has a part-time job, $9,400. Have a taxable interest, some money in the bank or invest in the CD. So it's 990. So added together is your AGI. Is George taxed on the Social Security benefit? AGI plus 50% of Social Security benefit is equal to $31,980. Compare this number to the base, $25,000. So it's greater than $25,000, less than $34,000. So only 50% of the Social Security benefit is taxed. So your 50% of Social Security benefit is $2,990. Then the gonna be taxed at the marginal tax rate. So the tax amount that you need to pay on the tiny Social Security benefit is $358.08. So yeah, this is if you're single, yeah, then how much your Social Security benefit is taxed. This is the situation. Anyway, so he has a part-time job. Okay, so yeah. Anyway, so this is for single. Okay. So this is for the last one I want to show you. This is very interesting. I'm just so surprised by this filing status. Anyway, so basically say if you're married and you filing separately, you're married filing separately, and you guys are living together. IRS just don't like your situation like this. I'm just so anyway, I don't know why. Anyway, that's just if you are married filing separately and you're living together. So in this situation, either of you receive, doesn't matter receive how much Social Security benefit you have, how much income. Let's just say you just only have Social Security benefit. Actually, 85% of your Social Security benefit is taxable. But if you have a deductible, that's a different situation. Let's see an example. It's very fascinating. This example is from IRS website, but I increased the let's say I increased the Social Security amount to $20,000, just to, compare, just make the, situation more dramatic. Let's say Bill and Eileen, they are married. They're living together, but they're filing separately. We only talk about Bill. Bill earned $8,000 during the 2019. So then he received additional $20,000 less Social Security benefit. So okay. So AGI without Social Security is only $8,000. So your PI is AGI plus 50% Social Security benefit is equal to $18,000. So basically, you have to understand the base. The base is 0. So basically, you have any amount of your Social Security amount, then you're gonna be taxed. So they basically tell you 85% of your Social Security benefit, which is $20,000, is $17,000 gonna be taxed. It's taxable. So it's added to your $8,000 to be taxed. So tax the amount, because he is filing separately, added together, you add this together, then it's about $25,000, and you minus the deductible, $12,400. So then the rest will be taxed at, I'm sorry, this is supposed to 10%. Rest is at a 10% and a 12% bracket. So the taxable amount is $1,314. So this is just because the filing status. If you're married, filing separately, and you guys living together, so this is your filing status expense additional on your Social Security benefit. But if Bill is single, if another situation, if Bill just a single guy, then AGI is this, your PI $18,000. You have to know, if you're single, you have a base $25,000. $18,000 is less than $25,000. Then in this situation, your Social Security benefit $20,000 is not taxable. Then Bill is only have a taxable income $8,000. Then you have a deductible $12,400. So Bill actually is not required to filing tax return. Oh my God! So this filing status matters. Okay, filing matters. This is the cost of you. I don't know why you guys married, living together and filing separately. Just do not filing separately, filing jointly. Anyway, I don't know what's the situation. Anyway, this is the worst filing status ever. So okay, this is that's all my a little presentation today. Okay, thank you for everybody watching this. Maybe it's a little lengthy and complicated, but yeah, hope you can go to IS website, find the publication 915, read the publication, then go through with my video. Maybe it's easier to understand. Okay, anyway, hope you guys have a good one. Bye.